right, future accounting bosses. Today we're diving into the world of statistical sampling, or as I like to call it, the money math that lets you test 100 transactions, but speak confidently about 100,000. This isn't just some textbook chapter. This is your future career superpower that will transform how you approach auditing, giving you the mathematical foundation to make million-dollar decisions with confidence while saving your firm countless hours of unnecessary testing and enhancing your ability to defend your conclusions before clients, regulators, and even courts if necessary. You're an auditor at Tesla looking at their $81 billion in annual revenue, facing 2 million vehicle sales transactions, and you need to determine if those financial statements are fairly presented. But testing every transaction would take years and cost millions. So instead, you'll use statistical wizardry to test maybe 100 transactions and make a dramatic leap that would make Evel Knievel nervous, using sophisticated mathematical principles to project your findings to the entire population with quantified confidence levels that transform a seemingly impossible task into a manageable one, all while maintaining professional standards and keeping the risk of incorrect conclusions at mathematically acceptable levels, which is the exact superpower I'm going to transfer to you today, along with the statistical secrets that separate the audit gods from the mere mortals, formulas that have literally saved companies millions and careers from ruin. Let me tell you about the time I was auditing a major clothing retailer during Black Friday season, facing thousands of SKUs across 500 stores, when the partner walks in and says, "We need 95% confidence by tomorrow morning," leaving my team of 3 staff auditors looking like I'd just asked them to calculate the exact number of stars in the galaxy. But we saved the day using the very formulas and techniques I'm about to teach you today, allowing us to test just 80 items out of 50,000 and confidently sign off on a $40 million inventory balance, earning that magical look of awe from the client CFO who couldn't believe we could draw such firm conclusions from such a small sample. That's the power of statistical sampling, and today, that superpower becomes yours, transforming you from an audit associate drowning in transactions to a sampling wizard who can navigate massive populations with mathematical precision while saving your firm thousands of hours and delivering conclusions that stand up to the toughest scrutiny. Audit sampling is like dating. You don't need to meet every potential partner to know what you like and don't like. You just need a representative sample that effectively mirrors the characteristics of the entire population, which requires understanding 4 key terms that aren't just boring textbook concepts, but rather your future weapons in the audit battlefield. The population, the entire set of data you want to draw conclusions about, like all 2 billion customer transactions at Amazon last year. The sampling unit, individual items making up the population, such as each iPhone sale in Apple's revenue account. The sample, your subset of items actually selected for testing. And sampling risk, the possibility your sample leads you to the wrong conclusion, which is what separates audit pros from amateurs, how you mathematically manage and quantify this risk, all of which combine to create the foundation of efficient auditing by allowing reasonable conclusions without exhaustive testing, but only when properly defined, selected, and evaluated using the statistical principles we'll master today. Sampling risk is like fishing in a vast ocean. Catching 20 fish from different spots and finding 2 contaminated leaves you questioning whether those 2 contaminated fish represent the whole ocean or just a polluted pocket, which perfectly illustrates the fundamental challenge of audit sampling. The possibility your sample misleads you about the whole population, which breaks down into 2 critical types that every audit boss needs to understand. First, the risk of incorrect acceptance, beta risk, typically 5%, which I call the false negative of auditing. Missing material misstatements that actually exist, like a doctor missing cancer on an X-ray, potentially fatal to your audit opinion. And second, the risk of incorrect rejection, alpha risk, also typically 5%, the false positive, concluding there's a material misstatement when there actually isn't, like diagnosing a perfectly healthy person with pneumonia, both of which must be mathematically managed to produce reliable audit conclusions and minimize the risk of issuing an incorrect opinion. The weather forecasting model. Your confidence level is simply 100% minus your beta risk. So with beta risk of 5%, your confidence level is 95%. That's the number you'll brag about in your audit report. And it's grounded in the central limit theorem from statistics, which states that as sample size increases, the sampling distribution of the mean approaches a normal distribution regardless of underlying population shape, creating a mathematical miracle that allows quantified predictions about millions of transactions by looking at just a handful, whereby if we drew 100 different samples from our population, about 95 would contain the true population characteristic within our calculated confidence interval, while the remaining 5 would produce misleading conclusions, that's our beta risk quantified, making it like a weather system that correctly predicts rainfall 95% of the time. You might occasionally get caught in unexpected rain, but the system is reliable enough to base decisions on, which is precisely how Ernst & Young approaches their audit of Apple's $394 billion in assets, allowing them to speak with statistical confidence about the entire population after testing just a tiny fraction. Statistical sampling versus non-statistical sampling is like choosing between a Tesla and a horse-drawn carriage. Both will get you there, but one uses serious technology. Or more precisely, statistical sampling is like using GPS navigation with precise coordinates and error margins, while non-statistical sampling is like following a local's directions based on landmarks. Both can reach the destination, but only GPS tells you precisely how confident you should be that you're on the right path and exactly how far off you might be, which translates in audit terms to statistical sampling using probability theory for both sample selection and evaluation, requiring random selection, where each item has a known probability of selection, allowing mathematical quantification of sampling risk and precision, the numerical measure of potential sampling error, creating a force field of defensibility when the PCAOB comes breathing down your neck, questioning sample sizes, as you can respond with because our mathematical model incorporating a 95% confidence level, with a tolerable misstatement of $2 million indicated precisely 45 items was sufficient, rather than the weaker in my professional judgment, which is why high volume, high risk, regulatory scrutinized accounts like Bank of America's cash balance demand the mathematical precision that only statistical sampling can provide. Imagine testifying as the audit partner responsible for a failed bank audit when the attorney asks, "How confident were you that the loan portfolio wasn't materially misstated?" With non-statistical sampling, you'd say, "In my professional judgment, the misstatement wasn't material," prompting the follow-up, "So it was just your opinion? No mathematical basis?" Whereas with statistical sampling, you'd confidently state, "I can state with 95% confidence that the true misstatement was between $32,500 and $67,500, well below our materiality threshold of $100,000, ending that line of questioning immediately because the difference is quantifiable." Statistical sampling provides a precise confidence interval, a range within which the true population value is likely to fall with a specified level of confidence, giving audit committees, regulators, and courts a clear understanding of the precision of your testing, which is why when the SEC is investigating, you want mathematical precision backing you up, not just your charming personality, as the difference between professional judgment and statistical certainty can be the difference between a successful defense and a devastating outcome. The risk factors we use in sampling: 2.3, 1 for 90%, 3.00 for 95%, and 4.61 for 100%. 99% confidence aren't arbitrary numbers pulled from thin air. They're derived from the Poisson distribution, which models rare events in large populations, unlike the normal distribution's 1.64, 1.96, and 2.58 values you learned in statistics class, because audit sampling uses Poisson to account for the discrete nature of errors. You either have a misstatement or you don't. There's no partial error. Described mathematically by the probability mass function P of x equals k equals lambda to the power of k times e to the power of negative lambda divided by k factorial, where L is the expected occurrences, k is the number of occurrences, and E is Euler's number, approximately 2.71828, which is analogous to building a bridge to withstand not just typical traffic, normal distribution, but also occasional heavy loads, rare extreme events. The extra support adds safety, but requires more resources, exactly as Facebook's auditors approached their examination of $118 billion in 2022 revenue, using these precise risk factors to determine sample sizes, because even at Facebook's scale, material misstatements are rare events that require this specialized statistical treatment, following the principle that, in auditing, we prepare for the rare but catastrophic, not just the common and inconsequential. Sample size formula is like a recipe for the perfect audit soup. The account balance is the base broth. Bigger pots need more ingredients. The risk factor is the seasoning intensity. More flavor requires more spice. And the tolerable misstatement is like the serving size. Smaller portions need fewer ingredients. Get the proportions right, and you'll have a perfectly balanced audit approach using the core monetary unit sampling formula that will save your career. N equals TB times RF divided by TM, where N equals sample size, TB equals total book value, RF equals risk factor on your confidence level, and TM Viscock's tolerable misstatement, how wrong is too wrong, which isn't just an academic exercise, but a practical tool used at Big Four firms to determine whether 50 or 500 items need testing, potentially making the difference between going home at 8 p.m. versus sleeping under your desk, since proper sample size determination is the difference between efficient audits and budget nightmares, embodying the principle that formula up front means freedom at the back end. Let's get practical with our formula by putting real numbers to this theory using Walmart's $5 billion inventory, where materiality is $100 million, and we want 95% confidence, a real-world scenario you'll face your first year as a senior. Walking through our MUS formula step by step. Total book value, $5 billion. Risk factor at 95% confidence, 3.00. Tolerable misstatement, $100 million, which gives us N equals $5 billion times 3.00 divided by $100 million equals 150 items. But there's a critical adjustment we must make, because at Walmart's scale, there will be errors, and the presence of expected errors increases the sample size, since we need more items to properly estimate the error rate. Applying the principle that no errors means smaller sample, more errors means bigger sample, a statistical compensation mechanism, following the universal truth that in sampling as in life, if you expect problems, you better prepare for them, which is why, with a 1% expected error rate, we multiply by an expansion factor of 1.5 to get a final sample size of 225 items, ensuring our statistical conclusion remains valid, even when encountering the anticipated errors. Here's something they often don't teach well in audit methodology training: the mathematics behind expansion factors, where the pros separate from the amateurs. When we adjust sample sizes using expansion factors, 1.5 for 1% expected errors, 1.6 for 2%, etc., we're applying a statistical concept called effective sample size reduction, where each error found reduces the number of error-free items in our sample, statistically shrinking our effective sample size for making inferences about the error-free portion of the population, derived from complex statistical models that mathematically compensate for this phenomenon. analogous to calculating how many extra tiles to order for a flooring project. If you expect 5% of tiles to be defective, you need more than just 5% extra because each defect reduces your effective coverage area, which is why, for our Walmart example, with a 1% expected error rate, we multiply by 1.5 to get a final sample size of 225 items, following the wisdom that the wise auditor plans for errors before finding them, ensuring we maintain our desired statistical confidence despite encountering the anticipated misstatements. Classical variables sampling, which we sometimes use for populations with high variability, the formula is different. It's like the alternative rock of the sampling world, not mainstream, but perfect for certain situations. Applying the central limit theorem directly to quantitative measures with continuous values, rather than discrete attributes through the formula n equals open parenthesis nr times sigma close parenthesis squared divided by tm squared open parenthesis, where nr equals normal risk factor 1.96 for 95% confidence. Sigma equals 185 degrees CELSIUS, standard deviation of the population, and TM equals tolerable misstatement, which is exactly what Google's auditors used when examining their widely varying revenue streams, from search advertising generating billions to experimental products with minimal revenue. Because the variability between these revenue streams is massive, and classical variables sampling accounts for that variability directly in the sample size calculation, making it analogous to reducing noise in an audio recording where each additional microphone helps. But you'll never eliminate all background noise, demonstrating the mathematical principle of diminishing returns that explains why massive samples aren't always cost-effective, or, as you could say, this method has a lot of variables, but the results are constant. The audit risk model, AR equals IR times CR times DR, represents an application of conditional probability in statistical theory, where AR equals audit risk, typically 5%, IR equals inherent risk, 40 to 100%, CR equals control risk, 20 to 100%, and DR equals detection risk, derived actually embodying Bayes' theorem from probability theory. P of A given B equals P of B given A times P of A divided by P of B. Connecting an 18th century probability theorem to modern audit methodology, Thomas Bayes never imagined his work would one day be used to audit TikTok's revenue, which functions like a series of safety filters. If material misstatements must pass through inherent risk, control risk, and detection risk filters to result in an incorrect audit opinion, the probability of failure decreases with each filter applied, representing a remarkable evolution from Bayes' original purpose of calculating probabilities of events after observing related events to today's application in determining how many Uber transactions we need to test based on their control environment. A stunning mathematical staying power from horse-drawn carriages to ride-sharing apps that ties together all aspects of audit risk assessment and directly influences our sample size calculations. Calculate with real numbers. If your audit risk is 5%, inherent risk is 100%, and control risk is 60%, you can determine your detection risk through the formula DR equals AR divided by IR times CR, giving DR equals 5% divided by 100% times 60%. 60% equals 5% divided by 60% equals 8.33%, which means your confidence level needs to be 91.67%, 100% minus 8.33%, affecting your risk factor and ultimately your sample size. Interpolating between a 90% risk factor, 2.31, and a 95% risk factor, 3.00, we get approximately 2.8 for 91.67% confidence, which demonstrates the direct mathematical relationship between risk assessments and sample sizes, and has real-world impact as proven when auditing a major tech company with high inherent risk but decent controls, where this exact calculation saved about 40 samples compared to the standard approach of defaulting to 95% confidence. That's 20 hours of audit time at $300 per hour, or a $6,000 savings from one mathematical calculation, like finding money in the couch cushions of audit efficiency, showing how a deep understanding of the risk model's mathematics can significantly improve audit effectiveness while maintaining the required level of assurance. Now that we know how many items to test, we need to know which ones, and here's where Moose reveals its statistical superpowers. It employs probability proportional to size selection, giving each dollar in the population an equal chance of selection, mathematically calculated as selection probability equals item amount divided by population total. For a $10,000 invoice in a $5 million population, that's 10,000 divided by 5 million equals 0.2%, meaning an item of $20,000 has exactly twice the selection probability at 0.4%, which functions like a nightclub with VIP access based on wealth. A customer with $100,000 in their account has 10 times better chances of being selected for audit attention than someone with $10,000. With the doorman, our sampling interval, checking IDs based on dollar value, not just counting heads, making it the Beyoncé of sampling methods that automatically focuses attention where the money and power is, directing our audit firepower to areas of greatest financial significance with mathematical precision, effectively allocating our limited testing resources to the transactions that present the greatest risk of material misstatement. For monetary unit sampling in practice, follow these steps. First, calculate your sampling interval by dividing the population value by your sample size. $5 million divided by 225 equals $22,222. Think of placing flags throughout the population at regular dollar intervals. Second, choose a random starting point between $1 and your sampling interval, let's say $15,000. Third, calculate your selection points by adding the sampling interval to each previous point. $15,000. $15,000 plus $22,222 equals $37,222. $37,222 plus $22,222 equals $59,444, and so on. Finally, select the items containing those cumulative dollar amounts. This is exactly how PwC selected their sample when auditing Microsoft's $168 billion in revenue last year, working through the cumulative dollar value of transactions one selection point at a time, demonstrating the principle that in MUS selection, you follow the money, and the money leads you to your sample, creating a self-weighting sample that automatically focuses on higher dollar value items without sacrificing statistical validity, giving you an efficient defensible selection method that aligns perfectly with the risk of material misstatement. Let's visualize exactly how MUS works in practice with a small business having just 4 customers. Alpha Inc. with $12,500 balance, cumulative $12,500. Beta Corp. with $18,000 balance, cumulative $30,500. Gamma LLC with $10,000 balance, cumulative $10,000. $40,500, and Delta Co. with $25,000 balance, cumulative $65,500, applying our sampling points of $15,000, $37,222, and $59,444, we select Beta Corp. Because our first selection point of $15,000 is contained within this account, between $12,500 and $30,500, we select Gamma LLC because our second selection point of $37,222 is contained within this account, between $30,500 and $40,500, and we select Delta Co. because our third selection point of $59,444 is contained within this account, between $40,500 and $65,500, while Alpha Inc. isn't selected because our first selection point exceeds its cumulative total. Notice how a customer with a $25,000 balance, Delta Co., has approximately twice the chance of being selected as one with a $12,500 balance, Alpha Inc., demonstrating the proportional to size feature of MUS working as designed, effectively allocating our audit attention where the dollars are concentrated. Stratification is the LeBron James of sampling. When I was auditing a luxury retail chain with inventory ranging from $5 earrings to $50,000 watches, simple random sampling might have missed the high-value items entirely, which is why stratification mathematically improves sampling efficiency by reducing within-group variance, based on the fundamental principle that total population variance equals the sum of between strata variance and within strata variance, allowing us to minimize within stratum variance by creating homogeneous groups, mathematically improving precision for a given sample size through the optimal allocation formula N1 equals N times N sub 1 sigma sub 1 divided by S, N sub I sigma sub I, where N sub 1 equals sample size for stratum 1, N equals total sample size, N sub 1 equals population size of stratum 1, sigma sub 1 equals standard deviation of stratum 1, functioning like airport security, where first-class passengers, high-value items, get 100% screening with body scans and bag checks. Business class, medium-value items, gets regular screening, and economy passengers, low-value items, might go through expedited screening. Different risk levels warrant different intensity of scrutiny, but everyone reaches the destination, a reliable audit conclusion, which is exactly how KPMG approaches Amazon's inventory across 175 fulfillment centers, stratifying based on value tiers rather than sampling equally from $2 USB cables and $2,000 laptops, following the principle, don't hunt mice with an elephant gun, and don't hunt elephants with a mouse trap. That complex formula may look intimidating, like something from a Stephen Hawking textbook. But here's the good news. In practice, most firms use a simplified approach you can implement immediately. Stratum 1 high value, test 100% of items over $100,000. These items are so significant that we test all of them. The risk is too high to sample. Stratum 2, medium value, sample items between $10,000 and $100,000. These items are important but numerous enough that sampling is efficient, typically applying MUS within this stratum. Stratum 3, low value, minimal sampling below $10,000. These items individually present low risk, so we test relatively few of them, focusing on identifying systematic issues rather than isolated misstatements. This practical approach balances statistical rigor with audit efficiency, ensuring comprehensive coverage of high-risk items while applying appropriate sampling to lower-risk items, as I implemented as a first-year senior on a financial services audit, prompting my surprise manager to ask where I learned it, following the principle, test everything important, sample what's significant, and skim what's trivial. A straightforward stratification approach that combines mathematical elegance with practical application. Slide 21. Stratification, efficiency, calculation, dollars and cents. Here's the mind-blowing calculation that will make you a hero to managers and partners. Quantifying exactly how much stratification saves using an accounts receivable example of $5 million, where without stratification, standard MUS would require 225 samples at 30 minutes per sample. That's 112.5 hours, costing $5,625 at $50 per hour. But with stratification, we'd approach it differently. Stratum 1, greater than $100,000. Testing all 25 items totaling $3,500,000. 70% of value in just 2.5% of items. Stratum 2, $10,000 to $100,000. sampling only 36 of 300 items, totaling $1,200,000. Stratum 3, less than $10,000, sampling only 9 of 675 items, totaling $300,000, yielding a total stratified sample of just 70 items, 25 plus 36 plus 9, taking only 35 hours at a cost of $1,750, saving an astounding $3,875, or 69% of the original cost, while actually providing better coverage of high-risk items than the unstratified approach, since we're testing 100% of high-value items, demonstrating why stratification is considered a best practice for substantive testing of material accounts. It's not just more efficient, it's more effective at identifying material misstatements, truly allowing you to stratify to satisfy both the budget and the risk assessment. Now we've done our fieldwork and found exceptions, so how do we evaluate them? Enter the statistical magic of taint percentages. Yes, it sounds like something from a medical exam, but it's a legitimate statistical term. Mathematically, taint percent equals open parenthesis audit value minus book value, close parenthesis divided by book value, which enables valid proportional error projections regardless of item size by providing a mathematically unbiased estimate of total misstatement, where precision improves with larger samples and decreases with greater taint variability, functioning like academic grading. A student scoring 70% on a 100-point test missed 30 points, their error rate or taint. But that same 30-point error on a 200-point test would only be a 15% taint. The denominator matters as much as the error itself, which is why when Deloitte audited Snapchat's rapidly changing user metrics, they used taint percentages to evaluate discrepancy severity rather than just looking at absolute numbers, allowing them to understand which errors were truly significant in context, following the principle that in auditing, it's not the size of the error that matters, but rather the size of the error relative to the account. Positive taint indicates understatement. Audit value exceeds book value. Negative taint indicates overstatement. Audit value below book value. And the magnitude tells you how severe the misstatement is relative to item size. Let me tell you about auditing a tech company's accounts receivable, where we found an invoice booked at $100,000 when the actual contract was for $70,000. Calculating taint percent equals $70,000 minus $100,000 divided by $100,000 equals minus $30,000 divided by $100,000 equals negative 30%. A red flag demanding investigation because while $30,000 might not seem material to a $50 million revenue account, a 30% error rate is massive, leading me to dig deeper and discover the sales team was consistently recording revenue at higher amounts than actual contracts specified. This wasn't isolated but systematic, ultimately revealing a revenue recognition fraud scheme reaching all the way to the CFO, where one taint percentage calculation became the thread unraveling the entire fraud, resulting in the CFO's disgraceful resignation, 3 years of financial restatements, and personal thanks from the audit committee chair for finding what multiple previous audits missed, demonstrating how one calculation, one statistical insight, could become a career-defining moment that you too might experience in a few years with the proper understanding of these statistical techniques and their power to reveal patterns that absolute dollar amounts might obscure. Now let's explore how we project errors to the entire population, starting with mean per unit, the simplest method mathematically while still being statistically valid, which applies the law of large numbers from statistical theory stating that as sample size increases, its mean approaches the population mean, calculated as projected misstatement equals average misstatement times population size, with standard error equals sigma divided by the square root of n, where sigma is population standard deviation and n is sample size, explaining why increasing sample size improves precision, but with diminishing returns. Doubling sample size improves precision by only about 1.4 times the square root of 2, like reducing noise in an audio recording, where adding microphones helps but never eliminates all background noise. One microphone giving 70% clarity, 2 microphones providing 85% clarity, not 140%. Demonstrating the principle of diminishing returns that explains why massive samples aren't always cost-effective, reminiscent of DJ Khaled saying, "Another one." But in sampling, each additional one yields progressively less improvement, making mean per unit the Toyota Corolla of projection methods, not flashy but reliable and effective for many situations, especially when the population consists of relatively homogeneous items with similar values. Let's make this real with Nike's inventory. Imagine we've selected a random sample of 60 items with a book value of $300,000, finding total misstatements of $3,000 understatement, where step 1 is calculating the average misstatement per sampled item, $3,000 divided by 60 equals $50 per item. And step 2 is projecting this to the entire population of 1,000 items. $50 times 1,000 equals $50,000. Projected misstatement, giving us our best statistical estimate of the total misstatement in the entire inventory population, which Nike's auditors would compare to their tolerable misstatement. If less, they accept the balance. If more, they dig deeper, demonstrating the beauty of mean per unit, its simplicity and intuitive nature, making it easy to explain to non-statisticians like clients and audit committees, though it has limitations for populations with widely varying item sizes, where a $50 average misstatement might significantly overstate or understate the true error depending on whether errors occur more in large or small items, which is why it works best for relatively homogeneous populations, like inventory with similar per unit values, or where errors are random rather than correlated with size. Estimation, the method Amazon's auditors used when testing their $514 billion in 2022 revenue, recognizes the relationship between audit values and book values in the sample, then applies that relationship to the entire population through a 3-step process. First, calculate the ratio of audit values to book values in the sample. For accounts receivable sample of $500,000 book value with audit value of $485,000, that's $485,000 divided by $500,000 equals 0.97. Second, project this ratio to the entire population by multiplying by population book value. $5 million times 0.97 equals $4,850,000. Third, calculate projected misstatement as the difference between book value and projected true value. $5 million minus $4,850,000 equals $150,000, telling us that for every dollar recorded on the books, only about 97 cents is legitimate based on our testing. This method is particularly effective when misstatements are proportional to item size, which is often the case in financial accounts, and accounts for the relationship between book and audit values, making it more appropriate than mean per unit for populations with varying item sizes, as demonstrated when Wells Fargo had their account opening scandal, where forensic accountants used ratio estimation to project the total number of fraudulent accounts from their samples, leading to the 3.5 million account figure that made headlines and showing how the ratio reveals what the raw numbers conceal. Now we reach the statistical heavyweight of projection methods, the upper misstatement limit calculation for MUS, used by Big Four firms for their most critical high-risk accounts, which integrates point and interval estimation from classical statistics through the formula UML equals MLE plus BP plus total IA, where MLE equals most likely error point estimate, BP equals basic precision population book value times risk factor divided by sample size, and IA equals incremental allowances, population times RF times taint percent divided by sample size, functioning like measuring flood risk for a riverside town. You've observed the current water level, most likely error, added typical seasonal variation, basic precision, and factored in potential heavy rainfall, incremental allowances, to determine the highest expected water level to prepare for. It's conservative by design, but when floods or material misstatements are at stake, better safe than sorry, which is exactly how Apple's auditors approach their $394 billion in assets, making it the gold standard of statistical projection that stands up to regulatory scrutiny, peer review, and litigation, embodying the principle from The Dark Knight that it's not the projection method we deserve, but it's the projection method we need. By providing not just a point estimate, but a statistically valid upper bound on potential misstatement, through a complete MUS evaluation example that will give you statistical superpowers. 90% of practicing auditors don't fully grasp using a sample of 225 items from Spotify's $5 million accounts receivable with 6 errors. Error 1, $12,000 with 30% taint. Error 2, $8,000 with 25% taint. Error 3, $5,000 with 100% taint, complete write-off. Error 4, $9,000 with 40% taint. Error 5, $15,000 with 10% taint. Error 6, $11,000 with 15% taint. We first calculate MLE, most likely error, as $12,000 x 30% plus $8,000 x 0%. 25% plus $5,000 times 100% plus $9,000 times 40% plus 15,000 times 10% plus 11,000 times 15% times 5 million divided by 2,500,000. $3,600 plus $2,000 plus $5,000 plus $3,600. 1,500 plus 1,650 times 2 equals 17,350 times 2 equals $34,700. Then calculate BP, basic precision, as $5 million times 3.00 divided by 225 equals $66,667. Then sum the incremental allowances at $146,668, finally calculating UML, upper misstatement limit, as 34,700 plus 66,667 plus 146,668 equals 248,035, which exceeds our tolerable misstatement of $100,000, meaning we cannot accept the recorded balance and must either propose an adjustment or perform additional procedures. This is a mathematically defensible conclusion that would stand up to regulatory scrutiny, peer review, and even litigation, demonstrating how the numbers have spoken and the auditor must listen through the statistical power of comprehensive MUS evaluation. Documentation is the unsung hero of audit sampling that transforms subjective judgment into objective, replicable processes, like the black box on an airplane that investigators examine after a crash to understand what happened and why, without which no one can reconstruct your thought process or defend your conclusions years later when the specifics have faded from memory, as illustrated by the senior manager who lost a partner promotion because their sampling documentation couldn't withstand quality review. They had the right sample size and found the right exceptions, but couldn't defend their work because they hadn't documented their statistical reasoning. Which is why you must document these crucial elements for planning, population size and characteristics, sampling method selected, sample size determination formulas and calculations, risk assessment considerations, tolerable misstatement and its basis, for execution, specific items selected, procedures performed for each item, results for each item, exceptions found and their causes, and for evaluation, projection method used, confidence interval achieved, comparison to tolerable misstatement, final conclusion and its basis, following the timeless auditor's mantra that the memory fades, but documentation remains, creating the paper trail that proves you exercised professional care and reached statistically valid conclusions. As we conclude this whirlwind tour of audit sampling, remember these sampling superpower principles. 1. Sample size is a mathematical decision, not a gut feeling. Use the formulas because professional judgment has its place. But sample size determination should be grounded in statistical principles that can withstand scrutiny from reviewers, regulators, and courts. 2. Stratification is your best friend. It saves time and improves effectiveness by focusing more testing effort on high-risk or high-value items, optimizing both efficiency and effectiveness through dramatic, achievable efficiency gains. 3. Taint percentages tell the story behind the numbers. The proportional measurement of misstatements provides crucial insight into the nature and severity of errors, revealing patterns that dollar amounts alone might obscure. 4. Projection of errors requires precision and professional skepticism. Proper techniques transform sample results into meaningful population conclusions, with rigorous projections and conservative interpretations that protect against sampling risk. 5. Documentation of your sampling approach is your shield against litigation. In today's regulatory environment, comprehensive documentation isn't optional, but essential for defending your work and demonstrating due professional care.